wonderful good day, ladies and gentlemen, to the uranium update on Commodity TV. The uranium market remains hot and a price test could be in the offing. What happens if Sprott decides to test the spot market for drying up and starts buying big again? This is likely to make the fuel buyers at the nuclear utilities break out in a cold sweat. Incidentally, a similar scenario to 2007, when the price of uranium shot from $40 to $140 per pound as major financial market players bought everything they could get into their hands. Interestingly, uranium prices have now continued to rise slowly over 6 to 7 weeks, eluding normal seasonal weakness. This could be a sign that the energy suppliers are slowly but surely coming under pressure as supply is becoming increasingly difficult due to the event in Niger, but also the expired long-term contracts. As existing contracts are exhausted and new long-term contracts tie up material, buyers are realizing that the days of easy access to cheap uranium are over. There is a real bottleneck that has changed the psychology of procurement managers. The supply and demand fundamentals underlying the market have changed dramatically. Just the majority of the world's production that is located in Russia, Kazakhstan, Nigeria, Niger, and many more in very uncertain jurisdictions could lead to a supply crash. Western policymakers are also trying to reduce dependence on Russian uranium by passing legislation in the US Congress that bans imports of enriched Russian products. This gives further impetus to utilities in America and Europe to secure future supplies outside Russia. Uranium remains extremely hot with a bright future. Exploration is now also coming back into focus. Latitude Uranium should definitely be one of them. The transformative restructuring has positioned the company strongly, diversified and reduced risk. The acquisition of the Angilak project in particular was a smart move, as $95 billion has already been invested here in the past. Through the last successful financing round of $12.6 billion, the company is also well positioned to carry out an extensive exploration program on both Angilak and the CUR.V project in 2023. The company is advancing 2 district-scale uranium projects with Angilak as the centerpiece. Angilak is a previously explored project with remarkable historical results and is therefore the focus. It has a world-class grade that is among the highest in the world outside the Athabasca Basin. The goal is to transition Angilak into a development project. The 2023 drill program will cover 5,500 meters and focus on the main zone to confirm continuity in the gaps of historical high-grade intercepts, extend mineralization down dip from the near-surface mineralized zone, and define new mineralization potential. Longer-term plans for Angilak include an updated mineral resource estimate and a review and expansion of regional targets. The Central Mineral Belt project, the CUR.V project, is conducting a Falcon airborne gravity gradiometer, gravity magnetic and radiometric survey over the entire belt. This is the first time in 60 years that data has been collected over this vast land package that will provide relevant data on new drilling targets and the geological potential of the region. The objective of the survey is to identify favorable gravity anomalies and coincident magnetic anomalies that are typically features of uranium and IOCG deposits. The survey has commenced and due to its scope, including evaluation, is expected to be completed before year-end. Latitude is very cheaply valued and the 1-year chart of the fledgling company looks interesting. We see a bottom forming here which has already reversed and the share price is starting to move up. We see a first price target in the area of 45 Canadian cents and in the longer term we trust the title 80 cents to $1 Canadian. David Talbot of Red Cloud sees the share even at $1 Canadian 35 in his latest research update. One can enter here favorably into uranium exploration which exhibits high quality. The big brother of Latitude Uranium is Consolidated Uranium, and again a company is spun off from CUR. Premier American Uranium closed its private placement with almost $7 billion Canadian at a price of $1.50 per unit. This includes a warrant at $2 Canadian with 36 months to maturity, with half a warrant attached per unit. Consolidated Uranium could resume uranium production in the USA in the next 2 years maybe. The previously producing mines Delaros, Brim, Tonium as well as Sage Plain in the USA could possibly resume production as early as 2025. This would give the share price a significant boost. The 10-year pointed figure chart looks like a great bear trap. Exactly when the price touches the upward trend coming from below, the title starts to turn. This could trigger a reversal formation already in the next weeks, and the share price could quickly go towards 3 Canadian dollars. Based on this, we see a price target of 4 Canadian dollars 25. Red Cloud analyst David Talbot sees here a price target of 5 Canadian dollars for CUR. In a further bullish uranium price scenario, we can imagine a price target of 9 to 10 Canadian dollars for Consolidated Uranium. You can also find all information on our Commodity TV app in German and English, as well as everything about commodities. Please note the following disclaimer. We appreciate a like and, more importantly, subscribe to our TV channel. The stocks discussed are or will become part of the SRC Mining Special Situation Certificate, and I'm a shareholder in the companies. Thanks for watching us, and bye-bye from Austria.